Hello and welcome back. Thank you very much for attending the T3 Live online home study course. My name is Pete Renzulli. In the previous lesson, we spent a lot of time on business goals and objectives, your personal goals and objectives, and previous to that, we spent a lot of time on gathering your resources. What we're going to discuss in this lesson, a very concise and to the point lesson, is how to develop the outline for your trading plan. Now, we're going to start to put together your objectives with your resources, develop strategy and tactics to implement those resources to ultimately reach the goals. So this lesson, quite simply, starting to put together your personal trading plan. Okay? First, we're going to get started with, based on your resources, your goals, your objectives, what do you need to learn, accomplish, or solve in order to run a successful trading business? Now, interestingly, a lot of people get into the business, they don't know what they don't know yet. And that's kind of interesting because there's different levels of traders, and I might have spoken about this before. There's the complete newbie, doesn't know anything. There's somebody who's tried it for maybe less than a year. You know, and actually while I'm going through this list, kind of quantify which one you might be. There's the second stage is maybe tried it for a year, not a lot of full-time devoted to it, haven't really made or lost that much money, so you really don't have a commitment yet. You don't really know what you need yet either because you haven't really made a full-time commitment. Then you have somebody who's doing it maybe 12 months to 3 years and keeps doing what's not working, keeps putting more money in their account, keeps banging their head against the wall, keeps wanting to be consistent with what's not working and not wanting to change, and wants to tell everybody all the stuff that they know about trading, but they're not making any progress. That's probably one of the most frustrating stages to be at because you have such an amazing passion for what you want to do and you want to make it with every fiber of your body to be successful. I'm going to tell you flat out, the thing you need to solve if you're in that stage, the thing that you need to learn if you're in that stage, the problem you have at that stage is you don't have a good trading plan that's aligned with your resources. If you did, you would have a very stress-free experience when you attack the market with that 3 years of experience you have. If you're frustrated, grinding it out and not succeeding, your plan is not detailed enough and you haven't considered enough. It's something that you need. And then the fourth person is actually a very interesting one, is somebody who's gotten past that point, is earning consistent money and simply needs to understand the strategies and the mindset for taking their business a little bit bigger. And we handle and work with those clients in a mastermind program, which is a little bit more in depth than just the coaching and the mentoring. Okay, so bottom line is, how do you plan to make it happen? Out of those four strategies, four stages of the trader path, which one are you? Okay, what do you need to learn? All right, next, trading plan components. We're going to discuss very briefly now what actually goes into the trading plan so that you can write down this outline and ultimately be putting it together so you can create a strategy for yourself and some tactics. All right, number one, strategy that defines your edge. Number two, what specifically will you trade, which we talked about in the last lesson. Number three, what time frames will you monitor? Interestingly, the time frames that you monitor will be determined by the time you can devote to being a full-time trader. Very big mistake that I see people make is they get involved in the business, want to trade intraday or day trade, whatever terminology you want to do it, while they're trying to work a full-time job. Don't do that. If you're working another full-time job, hold your trades 3 days, allocate and look at the time frames that will allow you. If you want to feel like you're doing something actively and then keep your full-time job, don't put yourself in a position, for example, just happened an hour ago where another big announcement came out, another big European headline came out, and you're down the block. And I'm going to give you a really good example of this. It's something that happened to myself with my time frame actually is the shorter time frame. What ended up happening was, I want to say probably around 5 months ago, there was an announcement late in the afternoon when I was short 3 different positions, in the money on all of the positions, and there was an announcement that came out. It wasn't even, it was not a pre-planned announcement. It was like one of those, I think it had to do with the Greek bailout or something like that, and everything just exploded, and I wasn't at my desk. So what I'm trying to get across to you is, if you're not going to be at your desk watching it full-time or can't guarantee yourself because you're doing something else full-time, now that was just a one-off incident, but I'm illustrating a point. You want to be at your desk in the time frame that you're trading in. So if you're swing trading or 1 to 3 days or that kind of thing, it's not necessary for you to have it logged in all the time. It's fun to look on your BlackBerry or whatever phone you have and see what the quote is. But if you can't be at your desk all the time to place an execution if something happens or if it's part of your strategy, expand your strategy a little bit. Put it out a little bit longer time frame. All right, next. Tactics to enter and exit the market. Those are very simply entry strategies and exit strategies. We'll get into those in a little more detail in a little bit. Money management. As I said before, up to 50% of becoming a successful trader. Understanding your money management. Money management and risk management always get confused. Money management is the amount of capital you're willing to commit to the market and to a trade, to an idea. Risk management is how you are going to allocate that money. So very quickly, money management is I'm willing to risk $300, just throwing a number out there. Risk management, $300 and I have to risk a point on the trade means I'm allocating how many shares? $300 for a point is 300 shares. So I have a $1 stop loss, 300 shares, risking 300. So money management ties in with risk management. Risk management is how you ultimately manage the dollar amount that you're willing to put out there. So don't confuse the two. They're not the same thing. Very important. And you have to plan for both of those. Risk-reward parameters. What are the minimal risk-reward parameters? And a quick criteria here, the longer the time frame you're invested, the higher your risk-reward parameters should be. If you're trading intraday and you're a lot more active, you can get away with 2-to-1 risk rewards because there's a lot of opportunities and you get a whole bunch of 2-to-1s and a bunch of 1-to-1s that should work itself out. If it's a much longer time frame where you're getting in today and you're going to get out 3 months from now, your risk reward should be much bigger because the time frame you're exposed to the market is going to be longer. Last but not least, performance review. How often do you plan on reviewing how well you're doing and if you're following your plan? Now, I know I touched on this, but I'm going to bring it up again. One of the single biggest things you should be reviewing every single time you get out of a trade, and if you didn't write this down, write it down now. Was it a good idea? Not did I make money. Did I follow my plan? Extremely different. Extremely different. Leave that in there. That's actually, everybody's human. It's extremely different. If you only focus on the results of the trade, you're not going to focus on how you achieve those results. How you achieve the results is much, much more important in the long run. On a trade-by-trade basis, your goal should be flawless performance. Period. The results come from good performance, provided you actually have an edge. So what am I telling you here? A part of your trading plan is when will you review? Very important. All right, next, trading strategy. It's a combination of conditions that match the concept. Again, concept could be value trading, fundamental trading, momentum trading, technical analysis, all of those different ideas. Conditions that match the concept, entries, exits, and money management parameters. All right, getting into it now. Trading strategy is a method or system. It's a step-by-step plan of conditions that when they're unfolding are identifying to you, here's my edge. And again, I know I talked about this. A lot of people do it the other way around. They put a trade on because they learn the entries. The entries are the last part. The entries are nothing more than a short-term ride on a long-term perspective. It's nothing more the train's going down and you're getting off. It's stopping where you're getting on, okay? Don't get it backwards. The way most people do it is they put the trade on because the first chapter they open up to is the entries. They get in and then they hope the conditions match their entry to make the market or the stock move in their direction. Do it the other way around. I already have these conditions that I identify as an edge. Let me find a low-risk spot to get involved. Make sure you keep that as the sequence. The sequence is very, very important, okay? Next. Strategy points you in the direction, the real reason to be in the trade. The entry is not the reason. I can't emphasize this enough. The entry is the spot you're getting involved. And the way I talk about this all the time with people that I work with, pick a side, then pick a spot. The side is the real reason to be in the trade. That's where the probability is. That's where the bigger money is. The right side is much more important than the right spot. Can't emphasize that enough. Okay, moving along. Strategy is a set of rules and conditions that will get you in and get you out of the market. So those rules and conditions are your entries and exit strategies. It's also the conditions that define your edge, which I just explained. Can you, in one elevator ride with somebody, can you? You're in an elevator, you go from the first floor to the 20th floor. They look at you, say, what do? You tell them you're a trader. They ask you a very simple question. Now, you don't know if that person sitting next to you is a multi-billionaire looking for something to do with his money or her money. Really? How do you trade? What's your edge? You better be able to come up with that answer if you expect to take money out of the market. Always go back to writing your plan as if you're trying to raise money. If you can't definitively understand or enunciate or clearly state how you attack the market, don't commit capital until you have a pretty good idea. And again, it doesn't have to be complicated. I have something in there that's a simple strategy just to give you an idea. It doesn't have to be this long, drawn-out computer program. But it does need to be something that's repeatable. That's the point there. It needs to be something you believe in, and it needs to be repeatable. The two things have to be in there. You believe it, and you believe it occurs enough that you have an edge to allocate money to the market. Okay, next. Two sets of conditions that you're looking for. Number one is an idea generator, which is basically defining an edge. And number two, entry and exit scenarios, which imply profit-taking or loss. It's actually very interesting that a lot of people don't combine an exit strategy with not only a stop loss, but a profit target. It's very, very interesting because probably most books put the emphasis on the stop loss because you can look at a chart and say, boom, if it gets down to that spot or gets up to that spot, that's where you get out for a loss. Well, you know what? We're doing this to make money. How about you have a target to make money and you spend as much time focusing on it's getting closer to or further away from your target so you can determine if you should still be in the trade. And that's a big part of working with a trading mentor or a trading coach as well. They will walk you through a trade where you're thinking about pulling the plug on a trade, and they'll look at you and they'll be like, it's working out. Do you see any reason not to hold on to it? And if the answer comes back, no, I have an itchy finger on a book a quick profit, ask yourself, go back into your trading plan. Is this how I planned on managing a position? And if the position says I want 3-to-1 based on these sets of scenarios, hold the trade. And again, a coach will be able to tell you that while you're going through the trade. Okay? Okay, next. Some of the things that go into those conditions, the market itself and the stock itself. Is the market easy to read today? What do the market internals look like? How easy or well is the stock trading today? Do you trade a stock when there's news, or do you like to trade it when there's no news? I can tell you my own personal trading, I absolutely stink at trading news. I hate it. Don't want anything to do with it. I want to trade stocks when there's just nice chart patterns, nice clean uptrend, nice clean downtrend, and nobody's knocking on my door to ruin my day. I don't want anything to do with news. I want technical patterns that have nice order flow, nice clean order flow, and nobody's going to ruin it by earnings came out and the stock's messed up for the next 3 days or the CEO quit. I stay away from that. Which, again, if you take it even a little bit deeper, my personal trading strategy, I don't trade commodity stocks well. There's just so much intraday news or stuff that gets affected by they found gold, they didn't find gold, oil was bigger, small. I'd much rather trade where there's earnings behind a company. And again, this is just my personal perspective. I'm trying to give you an idea of how deep you need to go to come up with a strategy you're comfortable with, because once you get to that point, trade the hell out of it. All right, moving on. Takes into consideration potential risk-reward in relation to objectives and resources. This is massively important, as I said before. I've seen hundreds and hundreds of traders not succeed because there was not a match between their resources and where they wanted to be. Learn how to make money. Learn how to earn money consistently before you get greedy and want to make big money sooner. Learn how to generate revenue. Always go back to the fact that you're running a business. You want to learn to make your revenue stream grow, which is trading profits in this case, before you move into a bigger store. Don't get the bigger store, which, again, relating it back to trading, means you're going into volatile stocks that can move very fast and move a lot before you have the revenues to cover what could be a potential expense. You don't mind taking bigger risks if you have the revenue to offset those risks when things are working out. You never want to put yourself in a position where 1 or 2 trades can put you out of business. Make sure you progressively grow where you match it. How many times now in the lessons have I mentioned resources, goals, objectives, and planning? Make sure that's a big part of it. And again, a couple slides ago, which of these skills do you need? What problems do you need to solve? And more often than not, the problem is being realistic about where you're starting, where you want to be, and the steps in between. And that's what continuing education and coaching is for. And that's what you're doing now. This is great. You're learning right now and continuing education, and hopefully you end up going deeper into learning a lot more than you do now. All right, next. I actually have here a very simple buying scenario or a simple system. I've spent a lot of time, and I don't want everybody believing that developing a system is incredibly, incredibly hard. It just needs to be done. It needs to be specific. So in this case here, I have a buying scenario where I developed an edge, or where this potentially could be an edge. I'm not going to say it is or isn't something I exactly do, but it's one that makes sense. All right, first, the daily candle, the close is above the open. So in other words, right now where it closed today, it closed higher than where it opened today. So in candles parlay, or whatever you want to call it, candles speak, that means it's a green candle. Daily close is above the 10-period simple moving average. The 10-period simple moving average is above the 20 simple moving average. So what's going on here? Intraday, it was strong. The last 10 days, it's above. And the last 10 days average is above the last 20 days average. So what's going on here? There's an edge to buying pressure. That's a simple scenario. All right, so what would somebody do for this as if it was a strategy? Look for an entry long tomorrow if the current price is above yesterday's high after the first half hour of trading. That is pretty detailed and specific. Ask yourself right now, can you come up with something that specific for not for some of the trades you're making, for every trade you make? Every trade you make should have that specific edge, conditions, entry. Period. Everyone. If not, you're gambling. You don't want to be doing that. You just, whatever's blowing in the wind, you're putting money to. That's not complicated, but I'm going to tell you right now, it was specific and repeatable. And there was an edge. There was an edge, specific, and repeatable. How many of your trades have all three of those? Every single one should. Okay? And last but not least, specific money management and entries and exits will be discussed in a little bit. So the first was just a scenario. The bottom part is actually managing the trade. All right, next, entries. I'm going to list a couple of different ones here. Volatility breakout entries, a consolidation pause entry, or a trend reversal entry. Time-based, after a half hour, after an hour, after 2 days, after 5 minutes. Chart-based, breakout of yesterday's high, yesterday's low, breakout of the first hour. Which one is it? Volatility-based. If volatility exceeds a certain amount, this is otherwise known as Bollinger Bands or Keltner channels, any one of those. Chart-based patterns, a flag, a channel breakout, a significant chart level, a wedge pattern, a 1, 2, 3 bottom or top. Ken Roberts made those very popular years ago. Moving average crossovers, test of support or resistance. Now, here's the main point that I want to know, and this is extremely important. I just listed probably 10 different scenarios you can use as an entry pattern. Pick one. Pick two at the most. You don't need every single one. Go back to the pizza thing. You're opening a pizzeria. Make the best pizza you can find. When there's a lot of people in the store, make one, make another one, make another one, make another one, make another one. That's what you're going to do with trading. Find the scenario that dictates you have an edge that you believe in, that you believe is repeatable and matches your resources, and then find the one entry pattern, the two entry patterns at the most, and just only look for those. Prove to yourself, not to me, prove to yourself you could follow one before you go out to more. And you might even find that one is so consistent for you that why would I bother? Why would I bother? All right, next. All right, exits and trade management. As we said before, a lot of emphasis is placed on stop losses. You got to put just as much emphasis on where to get out of a profitable trade and how you're going to manage that. All right, first one is initial stop loss based on an accepted dollar amount. We spend a lot of time talking about that. How to determine the dollar amount, very important here. How much are you planning on risking? Next type of exit is a break-even exit. When do you move the initial stop to a break-even point? After that, adding to positions. How do you know you should build a position and when you should build a position? It's going to be interesting because what ends up happening sometimes is you're in this good position, the trade moves up. Can you make a distinction between when a trade moves up and pauses, consolidates, flags, whatever you decide to call it? What dictates the condition for you to take that profit when it slows down versus you should be looking to add to a good position? I've already talked about it a couple of times. It's called trade expectation and trade concept. You need to know both, and that's got to be a part of your plan. Okay, next. Obviously, this will all be documented so that it can be repeated. How many times am I going to say that? I'm going to repeat it again. Your plan must be specific so it can be repeated. Success and consistency comes in the market from following your plan flawlessly. That assumes you have a plan that has an edge. Say it with me. Consistency in the market comes from doing all this planning and then following your plan. It comes from knowing what you're going to do next, not from what's going to happen next. The only way to know what you're going to do next, get started on the planning. Next. Stops and idea validation. Are re-entries significant for you? They should be. I'm going to tell you something right now, especially on short-term trades. Getting stopped out of a trade and the trade not still being valid is not the same thing. You can get stopped out of a good idea. Is the idea still good? If it is, get back in if certain conditions are met. That one pattern that we were talking about before. Wider stops for bigger targets. Think about swing trading. How will you know if you get stopped out if the idea is still valid? I just mentioned that you should know that. How will you know that? The easiest question is, have the conditions changed? Did the conditions change from my original entry? If the conditions have not changed, get right back in if the trade is still valid, if the edge is still there. Next, are you willing and ready to make the same trade multiple times, taking small losses until it pays off? I can't emphasize this enough. If you have a good trade idea but get stopped out, one of two things is happening. You have too many shares to allow the trade to play itself out, or number two, it's a change of trend. Now, you shouldn't have to make that trade more than once or twice at the most if you firmly believe the idea is still valid. So one of those two things, write that down. If you're getting stopped out of good ideas too often, too many shares, or it's a change of trend, be able to recognize the difference between the two. All right, next. Profitable exit considerations. There's two types and extremely different thought processes. Number one is exiting into momentum, scaling out and trading around a core position. It's a little more active. You know you want to be in the trade longer, but you want to take some shares off, put them back on if the conditions still warrant it. Next is a trailing stop. You're trailing a winning position and exiting as the stock moves against your idea. Now, the whole point of the second one is you want to, hopefully, if you're managing the trade well and it's doing what you expect it to do, the stock moves higher, and as it moves higher, it pulls back. You're selling it at a higher price than you could have if you got out into momentum. And the last one is trailing a winning position. It's going to create a bigger drawdown, but allow you to be into trades longer. Now, the interesting part of this last one is if you have a longer time frame horizon for your idea, for your concept, for your strategy, you have a trade that moves in your favor. I'll just throw a number out there, $1,000, pulls back 500. So you just had 1,000. Now you're sitting here beating yourself up, especially if you're a short-term trade. Oh, I just had 1,000. What do I do? Are you okay with allowing that $1,000 to become 500 in exchange for, if it follows through, to become 2,000? It's got to be a part of your strategy, and mentally, you have to be okay with that if it's a part of your strategy. But do you see how your stress level reduces dramatically in your trading when this is all planned out? Because now it's not something you didn't expect. You're ready for it. Okay? All right. Money management. This is very, very important here to be a part of the trading plan. And in my opinion, more traders have blown up because they haven't taken care of money management. They've gone straight to, where do I get in? Where do I? It's like saying, where's the gas pedal? Where's the gas pedal? I just want to get on the highway. Where's the gas pedal? You know something? Learn about how fast you should go before you worry about how fast you can go. And this is what money management is. Okay? This first part of money management, how much to risk per day and per idea. Second part, how much will you determine position size? When would you increase risk? Is there a broad market rally, an obvious order flow trade, or an A trade with room to go? All of these things are discussed in a lot more detail. Understanding how much risk, when you should increase the risk, and when you should decrease the risk is all part of money management. And then, as I said before, risk management is how you actually allocate those shares to the market based on the above points. And next, how many total positions will you enter at once? And what percentage of your risk capital will it represent? Do you see how detailed these points must be? Which profit-taking strategy will you employ? All of those, momentum, scaling back, or trend trading, actually trading for a bigger position. All of these things must be planned, and I'm going to say it again so it's repeatable. You go into McDonald's today, you're going to get the same hamburger you got yesterday, and it's a billion-dollar company for a reason. They know how they're making money, and they press it. Every single day, they run the business the same way. Nothing surprises them. Sometimes they'll come in with a McRib or whatever else it happens to be, but ultimately the bottom line is they're making all their money on the French fries, the hamburgers, and supersizing it. How do you understand where your cash flow is coming from, how your consistent returns are coming from if it's a little longer term trading, and how do you determine when it's a bigger opportunity that's available? How do you know when there's a bigger trade expectation? And if it's a bigger trader expectation, how do you plan to allocate more money and manage that trade? Plan being the key word there, if those conditions arise. So all of these things go into your trading planning. So there's the edge, there's the strategy, there's the tactics, there's the entries, there's the exits, there's the money management. And you put all of those together, you ultimately get to the point where then you have to learn how to manage the positions, and you keep cycling through it. Trading at the elite level, when somebody really understands what they're doing, is boring because they're doing nothing more than following their plan. Trading gets stressful more often than not because you're either fighting your plan, you don't have a plan, or the market is not matching your plan at all and you continue to trade anyway. I'll see you next time.